Hey, what's up you guys? Welcome back. So I promised you guys I would make a separate video talking about the Fitch downgrade news. So here is that video. So we'll go through a newspaper article talking about it, and we'll go through what it all means and what it means for us as investors going forward. So without further ado, let's jump right into it. Wall Street fell on Wednesday after a move by a rating agency, Fitch, to downgrade the US government debt rating, which hid an appetite for risky assets around the world. Fitch downgraded the United States to AA plus from AAA, citing financial deterioration over the next 3 years, as well as the growing government debt, the second major agency to cut the country's rating after Standard & Poor's stripped of its AAA grade in 2011. So what does this all mean? First of all, you have to realize that countries have credit ratings the same way that individuals have credit scores. So, for you and me, it's called a credit score. For companies and countries, they have what's called a credit rating. It's basically a measure of how risky the debt is or the lender is. So if you're a AAA, which is the highest rating according to Fitch, this means that this country has a stellar record, and if you lend money to them, you're going to get your money back or with whatever yield that was promised. I believe only a few countries around the world occupy this AAA rating, which before the downgrade included the United States, of course, but now it only consists of countries like Switzerland, which is a country that is known for its financial soundness. Now, a AA plus rating is still good. It's on par with countries like Finland. However, it's still not a good look for the United States, as this is likely to make the stock market more volatile. Now, the reason why Fitch decided to downgrade the United States debt rating is due to a multitude of factors, with a major one being cited as the continued standoff and brinksmanship shown by the United States government every time they need to raise the debt ceiling. Now, if you don't know what that is, the U.S. government has a policy that is written into the Constitution that there's a maximum amount of debt that the U.S. is allowed to borrow. And if they want to increase that limit, it needs to go through Congress. Congress needs to approve. However, this leads to a lot of fighting and bickering since the U.S. Congress, especially these days, is heavily divided. It's more divided than ever before, and partisanship is a real problem. Now, this is actually an uncommon problem in terms of the debt ceiling thing that is kind of unique to the United States because other countries around the world, they don't have a debt ceiling. Other countries around the world, most of them, including Western democracies like Canada, UK, Germany, whatever, they just pass a budget and, if it requires borrowing money, then they borrow money, right? And there is logic, though, I think, to having a debt ceiling because I can definitely see how the founding fathers of the United States thought that it would be a great idea because it would avoid the U.S. from taking on too much debt. But I don't think they foresaw the issues that this would generate down the line. The fact is that the U.S. budget deficit nowadays is so large that the government could not run without debt. Otherwise, they would have to raise taxes massively and on everybody. And I know that there's a small group of people who are like, that's exactly what we need. We need to raise taxes on the rich. But I think if you're saying that, let me just stop you right there, okay? I think if you're saying that, you haven't understood the full gravity of the situation, because if you actually look at the numbers, the U.S. debt situation is so bad that even if you tax the rich at 100%, that will still not be enough to solve the problem. And also, if you tax the rich too much, they tend to leave the country. So that's also another problem. So in effect, you could actually make the problem worse by raising taxes on the rich too much. And to fully solve this problem, you'd have to raise the tax on the middle class as well, which is politically untenable. But in any case, I don't want to get into the politics too much. Let's circle back into the economics side of things. What you have to understand is that due to the dominance of the US dollar and just the US economy in general, a lot of these things, they're pegged to the US government debt market. So if you have a U.S. debt being considered risk-free, for instance, because the U.S. is going to pay back its debt, and if you're a major corporation, then you'd obviously be more risky than the U.S. government, right? So you would peg yourself to the US debt, and then you would offer a slightly higher risk premium on top of that. So a higher interest rate or a higher yield, they say, in order to justify to an investor why someone would give the money to you as opposed to buying a US government bond. And if you're a smaller corporation and you need to issue debt, well, then you're less trustworthy than the large institution, right? Who's less likely to go bankrupt. So you'd have to even like offer a higher yield. These are called yield spreads. And it's the difference, let's say, between government bonds versus large cap company bonds versus small cap company bonds, and et cetera, right? But the point is that everything kind of uses the US Treasury market or the government bonds as the basis. So if all of a sudden the US debt is not risk-free anymore, meaning that we have a risk premium attached to it, then we have a problem because it disrupts this whole equilibrium. If there is now a risk in US government bonds, then yields have to go up because you have to compensate investors for the extra risk they're taking on because they're buying a lower rated bond. You get how that works, right? Now, the easiest way to understand is that rich people get a lower interest rates on their loans compared to poor people, right? Banks like lending to rich people because they know that they'll most likely be able to pay back their debt versus if you run, let's say, a payday loan place, the people who are lending the money, who are borrowing the money, they're at a higher risk of not being able to pay you back. So to compensate for that risk, you'll need a higher interest rate from them. So this is why people say that it's actually more expensive to be poor. And I know that sounds really unfair, but that's just how this stuff works, right? It's just economics at the end of the day. It's risk to reward. So yeah, you're seeing already a rise on US debt. So the 10-year treasury, which is the 10-year bond, and these rates are annual rates, by the way. So it's already at around 4.2%, slightly less than that. Now, the main cause of this is, of course, the Fed raising interest rates, which are making the yields rise in the first place. But this Fitch downgrade obviously didn't help. And this is why the stock market is kind of pulling back a bit, because you can now get 4.2% yield on a 10-year treasury. As in, if you buy a treasury bond, a 10-year treasury bond today, you can lock in a 4.2% annual yield. And I know I just spent this whole video talking about how the downgrade affects the credibility of the United States debt market. But to be honest, AA plus is still a pretty good rating. And it's not enough of a downgrade for people to like absolutely lose faith in the United States government debt completely. So yeah, right now you can lock your money up for 10 years and get like a 4% or higher than 4% annual rate of return, which for you might not sound like a lot. But for institutions, I can definitely see how this is tempting, right? Especially if you're a big pension fund and you don't want to take risk. Well, maybe a 4% per year return is more than good enough to get you by, right? So institutions might be finding this deal rather tempting, so they might be withdrawing money from the stock market and putting it into the bond market, which is why we're seeing kind of a pullback in the stock market. Now the question is, how does this affect people like you and me, and how does this influence my strategy? Well, the short answer is it doesn't really influence my strategy. I think long term that people are still gonna want to be in companies, want to be in the stocks of companies that are changing the world. Right now, I think this news is hot off the press and people are making adjustments to their portfolios, especially maybe the big institutions, and that has enough weight to kind of move the entire market. But I think a lot of this stuff, especially in the retail space, for people like you and me, you see people freaking out, and a lot of people are acting out of emotion, and that's kind of what you want to separate. You want to invest with logic and not with emotion. I think give it, 6 months to a year. Is anyone still going to be talking about this debt downgrade in 6 months? Right? I think that I've been in the game for long enough to know that there's always something new, right? There's always something new in the news. That's why they call it the news, right? And there is such a thing as being too plugged into the news. So again, this news doesn't really change my strategy. I think long term, this might be even bullish for the stock market. And let me explain to you why. This is because if you look at the chart of US debt interest payments, it is skyrocketing. The interest portion is almost $1 trillion per year. So to put that into perspective, the US defense budget is around $900 billion per year right now, at least. So if you look at how powerful the US military is, if you just think about it, think of everything they spend money on, all the tanks, all the fighter jets, all the training they do. If you add that all together, the US government is spending more than that per year on an interest alone basis to service this debt. And I emphasize again, this nearly $1 trillion expense on the interest is on the interest portion alone, which does not include paying down the principal. And a credit downgrade is only going to make this issue worse because, as I said earlier, you have to pay more interest to compensate for the credit downgrade, right? For the extra risk. It's called the risk premium. So yields are going to go up. So my argument for the past year is that this trend of the US debt interest payments is absolutely unsustainable and that the Fed will have to pivot to cutting interest rates and printing money in order in the not too distant future in order to avoid a default. And think about what you would do, right? If it wasn't the US government, if it was an individual person, if this happened to you, where if you owed a bunch of debt, but you had the power to control the interest that you pay on the debt, or the interest rate rather, would you rather that interest rate be high or be low? I would think that you would want it to be low, right? So you would preferably have it at 0% if you could help it. Why would you raise the interest rate on yourself? So I do believe that the Fed will lower interest rates soon, and by soon I mean within the next 6 to 12 months. So that's my idea of kind of what is soon if you want a definite timeline. And when that happens, when the Fed lowers interest rates, I think that's going to be really good for stocks. But in the meantime, there will be some volatility for sure, especially since this news is still fresh. Anyways, I'll leave the video here. Hopefully that video was informative to you. And if you like the video, please be sure to give this video a like and consider subscribing to this channel if you like the series. Be sure to follow me on Twitter, now X, and my username or the link to my profile is down below in the description as always. With that being said, I'll see you guys in the next video. Bye-bye.